episode 2 of the Boom and Crash Capitalizer. Today we are going to be looking at price action tools that we can utilize to find entries and exits in the marketplace. But before we continue, we're just going to do a recap of what we discussed last night. We discussed about what boom and crash is all about. We listed all the boom and crash instruments that we can trade, identified the strengths of each instrument. We looked at the volume that we can trade, the minimum up to the maximum lot sizes for each instrument, and we identified the importance of trading boom and crash. Lastly, we gave an idea of what Boom and Crash Capitalizer, or BCC, is all about. So today we'll be looking at price action tools that we at Capital Trading utilize to find entries, right? So Boom and Crash is rather a more price action environment with 0% interaction from fundamental events. What this means is the better you analyze, the higher chances of winning. So you have to back test, you gotta review, you gotta identify repeating events, repeating patterns, and just put yourself in a position where you are able to frame better setups in the marketplace. Crash is just a bunch of numbers crunched by a computerized algorithm. So you just have to become a better price action trader to be able to frame better setups in the marketplace. So what exactly do we mean when we talk about price action? When we talk about price action, what we are saying is we want to, or what price action means is it describes the way a market moves, including its trends and its key support and resistance levels. You need to know how price is going to react when it reaches specific levels in the marketplace, right? So technical analysts look to price action on charts to look for patterns or indicators that can help predict how a security behave in the future and to time entry and exit points of trades. And technical analysis strategy should be at least 78% accurate. With that, that in short means that price action varies for traders, right? Some traders utilize indicators, some use recent price action behaviors and try to mimic the future, for the future, right? How they're going to perform in the future. So now, when we talk about price action here in capital trading, what exactly are those tools that we can utilize to frame those entries and exits? So from yesterday's video, we did give recognition to ICT, who is the inner circle trader, whom will be utilizing his concepts in order to find entries and exits in the marketplace, right? So on the screen we have 6 tools that we are going to utilize for BCC. We have the ICT order block, we have the ICT propulsion block, we have the ICT breaker block, we have the ICT liquidity void, we have the ICT fair value gap. So if you go on his channel right now, you get a more clearer picture of what these are. But what we're going to do is we'll try to find a common base ground for what these concepts or what these tools are and how we are going to utilize them to trade boom and crash, right? So we are going to start with the ICT order block. When we talk about the ICT order block, an order block is a theory that is famous. Almost every trader out there tries to mention an order block in their trading education or just in their trading journey. So we have two types of order blocks. We have bullish order blocks and then we have bearish order blocks. So when we talk about a bullish order block, we mean the lowest candle or price bar with a down close that has the most range between open to close and is near a support level, quoted from ICT himself. And when we talk about a bearish order block, we look at the highest candle or price bar with a down close that has the most range between open to close and is near a resistance level. So I want you to note this. We are talking about most range. So you'll realize that we might see two candles and that might look like order blocks, but we are going to choose the one with the most range because that seems to be the one with more strength, right? So let's dive into the anatomy of an ICT bullish order block. So we have about 5 areas of interest that we look for when we are trading on a bullish order block. We want to look at the candle's high, the candle's low, the candle's body close, and the candle's body's open, and finally the mean threshold or the 50% of the body of the range of the candle. And then the same thing goes for the bearish order block. We look for the candle high, low, body close, body open, and the mean threshold of that candle. So what that means is you look at those areas, they are sensitive. It's not a one area that we can say when it touches the high price we buy or when it touches the low price we sell. No, you realize that it's one of those features that, or one of those 5 features that we are going to utilize to frame entries on, right? So I'm going to give an example of how to utilize a bullish order block. So on the screen, the highlighted areas, if you look at the first highlighted area, you look at this last down close candle, the green candle here, and you extend it to the right, so you realize that what price did is price went up. So what that means is they took out the high of this candle and they went up, and then they came back and found support in this area or in this level. So what we do is we are going to find an entry. We utilize this to find a buy. We go long here, and then to exit at a specific level on the upside, right? We have another example here. You look at this down close candle here. If you extend your eyes, you realize that price went up and then came and retested this area and then continued on the upside, but they did come back later and they tested this area and continued to go up and take out this previous swing high, right? So let's focus on this candle for a moment. Remember those 5 features that I had identified. If we look at this candle here, on the first touch, you'll realize that they reacted to the body open, or not the to the body open, and then you look at the second touch, it's like they went to 50% or the mean threshold of this candle. So this is what we meant when we say these are the areas that are sensitive. So with that said, that means if we are to go long, or if we are to put in a buy position here, we are going to make sure that our risk is below this candle here, because price might dip deeper and still respect this level as its support level. So that's how you would use this a bullish order block to frame longs. And then let's look at bearish order blocks, looking for shorts or going short or selling at a higher price or at a bearish order block. So I'm going to utilize this candle here. If you look at this candle, price came up and then they went down. They took out the low of this candle. This means validation. The next time price comes back up, we should expect resistance levels on this candle. So price did that. They came and then they tested the opening of this candle and they continued on the downside. And they did the same thing at a later time. They still came back up and tested the low of this candle and went on the downside. We have another example here. Price did come here and they went down to validate this order block, and they came back at a later stage. So what we do is immediately when price does that, we look for shorts, or we look to sell price when it comes back to these order blocks, right? So this is how you utilize order blocks to find entries in the marketplace. And then we are going to dive into the ICT propulsion block. So what is an ICT propulsion block? So when we look to go bullish, this is how we define a propulsion block: a candle or into a down candle, right? Or a bullish order block, and takes over the role of price support for higher price movements. And then when we look to go short or we look to sell, this is how we define a propulsion block. This is a candle or price bar that has been previously traded into an up candle or a bearish order block, and then takes over the role of price resistance for higher price movement. So what we are talking about here is, remember that we have an order block. So price tend to come and test an order block, and then the last up close candle, if let's say we are going long, we are going short, the last up close candle after it tested the order block, that turns into a propulsion block, right? So I'm going to demonstrate that, but first we need to understand the anatomy. It's the same thing from the order blocks. We respect the high, the low, the body open, the body closed, and the mean threshold. So those are our sensitive levels or sensitive points when we are going long and we are going short using a propulsion block, right? So a demonstration, remember this, if you look at this candle, this was a bullish order block, right? So what the price did is they went up and then they retested this order block over here, and then price went up again. Remember the definition of the bullish propulsion block. It says a candle or price bar that has been previously traded down into a down candle, right, or a bullish order block, and takes over the role of price support for higher price movement. So this is what happened here. Price went up and then came and found support on this order block, and then it went up. So the moment it goes up, this down close candle, it becomes our propulsion block. So this is where now it takes over the role of support for higher price movements, and it did exactly that. We have this down. Remember that we want the price with the most volume, with a large range. So this becomes our order block. We disregard the small one. We'll rather consider this one with the large range, right? So this is our order block here. So what price did is they went up to validate this order block, then they came back down into the mean threshold of this order block, and then they went up. So that means our eye now goes to this next up down close candle. So this becomes our propulsion block. So it acts as support for higher price, and it did that. We took out the previous high and it continued on the upside. Another example, we have this as our order block here. Price came, tested this order block. Now the down close candle becomes our support for higher prices. It came down onto this propulsion block and it went up. So that's how you look for propulsion blocks when you're going long. An example, when you're going short, so what price did here was, if you look at this up close candle, this was our bearish order block. Price came to test it and then it went down. So that means our eye goes to the last up close candle. We can disregard this 2 week candles and just consider this candle with a large volume or with a large range. And then what price did is, immediately after testing this order block, they went down and then they came back up. They found support on the propulsion block here, and then they continued on the downside, right? So that's what happened here. Another example, we have this up close candle, right? So what they did is they went down and then they came to test this candle. So our eyes go straight next to this up close candle. So what they did is they went up and then they came to retest it, and then they continued on the downside. So that's how you look for propulsion blocks, right? So now we jump onto our next price action tool, which is the ICT breaker block. So when we talk about breaker blocks, just one of those price action tools that if you do not study or backtest on your charts, you would have problems identifying them, because what happens is sometimes you can wait for order blocks, but price might not exactly reach for order blocks. It might just return meets its way to the order block, and just, if let's say you are looking to go long, and then instead of going to fill the order block, they just go long. They find support on some level and then they continue going long. So this level, it might be the bullish breaker block. So what is a breaker block, or what is a bullish breaker block? It's a range or an up close candle in the most recent swing high prior to an old low being violated. Like when we talk about prior old low, or prior to an old low being violated, we might talk about stop hands or something like that, right? So I'll demonstrate what I mean, but let's jump to the definition of the bearish breaker block. A breaker block basically is a down close candle in the most recent swing low prior to an old high being violated. It's the same thing for order blocks and propulsion blocks. We look for the same points of sensitivity from the high up to the mean threshold, right? So I'll jump that. So this is a demonstration. This is how you identify a breaker block or a bullish breaker block. If you look at this over here, you realize that what I did is I took 1, 2, 3, 4 candles, because they were all going up. So what we do is we combine them into a single propulsion, not a propulsion, but into a single breaker block, right? So if you look at the bottom left, you'll realize that there is an X here. And then if you extend to the right, you realize that this X was violated. So this is an old swing low that's been violated, or a stop run below the swing low, and then they went up. What happened when they went up? They took out this high, and then what they did is they came back down and found support on this high. So this is our breaker block over here. So price will violate an old low and then go up, and then we look for the most high, and then they take that high out and then come back to find support on that level and then go to the top side, right? So this is how you find longs using a bearish or a bullish breaker block. So I'm going to demonstrate in a bearish environment. We have this old highs over here. Price came, violated an old high, and then went down, and they took out this. We look at this previous low that was taken out, and then when they took that low out, they came back up and found support on the of the candle and continued on the downside. So this is how we trade breaker blocks. You'll realize that sometimes you would want price to go up immediately after taking an old low. You would want price to go up, and you trade from an obvious point of entry, probably an order block or this propulsion block over here. But we do not get that case on every occasion, right? So we'll utilize breaker blocks to go short on this kind of setups. So the next thing we'll be looking at now is the mitigation block. So a mitigation block basically is a block or a down close candle formed from when the market fails to make a lower low. And then a bearish breaker block is an up close candle formed when the market fails to make a higher high, right? So instead of taking, let's say in a bearish environment, remember with a breaker block, we are going to take out an old swing high, and then we continue on the downside and then retest that candle that was used to go up and take out the previous high. With the mitigation, it's not like that. The market will fail to take out an high, right? So let's demonstrate that. This is when we are looking for longs, or we are looking for bullish market conditions, right? So if you look at the current example, you'll realize that what price did was they came and then they failed to go lower than the low. So that means this is a failed swing low, right? They did not go they did not make a lower low type of pattern or environment. So what we do is we are going to look at the last up close candle movement to retest this order block over here, this right here. Then we extend this to the right. If you look at this, you'll see sensitivity. Price came, then went up. So what does that mean? This means this is our mitigation block. And then you continue extending price to the right. Price came back to this block over here, and they found support. They went to the upside, right? If we continue, okay, they did not test the mitigation block here, but rather they used this order block. So this is how mitigation blocks work. Remember, failed lower of no, it's not a lower low. They came and then it's a failed swing point, and then they went up. We used the last candle that was used to push price down as our point of support. Now let me clarify this on a bearish environment. So on a bearish environment, you realize that what price did here, instead of coming, we had this swing high and price came but failed to take out the swing high, right? So this is a failed swing high. What we do is we look at the last down close candle that was formed before price went up. So this candle right here, if we extend to the right, price took it out here, and then what they did is they came, let's extend again, extend to the right, they came and found resistance on this level, right? They went down, they came again, they still found resistance on this level. They went down, they still returned and found resistance on the same level. So that means this level is powerful. So we call this right here a mitigation block, right? So when ICT describes this concept, he explains that this is when everyone who was long here and they are underwater here, what they do is they're going to take the market higher so that they reduce their losses on this candle or on this level here. So we call that's why it's called the mitigation block. They are mitigating their losses from the marketplace. So if I go back to the bullish mitigation block, all the sellers here who everybody who sold this up movement here, what they did is when price went, they pushed price down, and then when it went up, they were underwater, and then when they pushed price down and tried to mitigate their losses on this level here. So basically this is where the concept of mitigation blocks comes from. So now let's jump into what a liquidity void is all about. So when we talk about a liquidity void, this ICT explains this as a range in price delivery where one side of the market liquidity is shown in one-sided ranges or candles. So basically, when we talk about liquidity void, this is when the market trades to the upside and there's no return to the downside, or there's no retest or retracement, or we had a drop to the downside and there was no return to the upside or retracement to try to fill up that space. So we call that a void. We call it a liquidity void, right? Now let's identify liquidity voids in a chart. So you look at this, where when price reversed here, it went down, and forget about this here. Let's imagine we are in live market conditions, and what price did is they went down with all these green candles or these bearish candles. They went down. So what we do is we would like price to come back to the upside and probably find support on a level. It might be a propulsion block, it might be a bullish, a bearish or a block, it might be a mitigation block, it might be a breaker block. So depending on what the market is presenting to you. So we expect price to come and fill up these pockets of liquidity. It's the same thing here. Okay, we had this, and then price came to fill this, and then it continued going down. So we had this level here too. Price came, retested, we had this right here, we had this down movement. So price remembered this area at a later stage and came and filled this void over here. We had this down movement, price came back and filled this. So the question now becomes, what's the importance of this voids? But before I jump into the importance of this voids, let's look at liquidity. Let's identify liquidity voids in bullish market conditions. So we had price going to the upside here and then returning at a later stage to fill up this upward movement, and then they continued on the upside. We had the similar scenario here. They went on the upside and price came back at a later stage to fill this void over here. So now back to the theory. What happens is we don't jump on price when it's already moving. Rather, would rather anticipate a retracement or a return back at a later time or at a later stage, so that we frame our entries there. So if we see price movements, hasty price movements like these ones, what we do is we want to see if price is gonna come back at a later stage and whether it's gonna find support here on this order block, and then we look for longs here to the upside. So that's what we do. We anticipate price. We don't chase price, we only chase money, right? We don't chase price. So the only way to chase money is you have to be patient, you have to be able to anticipate, and we don't cry over price that's already run away or that's already moved, because we are in a position to identify entries anywhere at any time on any instrument. So that's what we do here. We make smart decisions. So that's where the concept of liquidity voids comes in, right? We are going to talk more of these when now we are going to put all of these concepts together in a chart on episode 4. So we have our last tool here. We have the ICT fair value gap. So a fair value gap is famous. So if you don't know what a fair value gap is, I don't know which side of the trading world you live in, because it's been making rumors. It's just one of those tools that's so powerful that some people just use fair value gaps as a trading model. They just look for setups just using this one model. They don't utilize anything else. They just find this a more simplistic and effective way of identifying setups in the market. What exactly is a fair value gap? So this is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame charts in the same range of price, right? That's how he explains it. So now let's look at the anatomy of the bullish fair value gap. So when it comes to a fair value gap, we only have 3 points of interest or sensitive levels of our fair value gap. We would like to look at the body close, the body open, and the mean threshold of the candle of that fair value gap, right? It's the same thing for the bearish conditions. Now let's identify fair value gaps in a chart. If you look at the chart on all the highlighted areas, you realize that there's levels, or these are areas where there was no price action between the last previous high and the next candle's low. So we call this a fair value gap. we call it a gap because it's like the market gap to the upside. So you'll realize that when price did this at a later stage, remember we identified the mean threshold of this level as a sensitive area. So price came back at a later stage and tested the mean threshold of this level here and then continued on the upside. So this is how you identify fair value gap. Another example, we have this right here. We look at the last candle. We look at the previous candle before the one we are looking at, and the next candle's low that comes after the candle that we are looking at. This right here is our fair value gap. So if we are to extend this to the right, you'll realize that price did come back to this area. So what price tends to do is price would use this levels here, the fair value gaps, to find support levels and go to the upside, or price will come back to this level to fill up this and just continue on the downside and find support on a much lower level or point of on a price action tool like an order block or a propulsion blocks, right? So this one has not been identified, but if you look at this one, you look at this up candle, and then you look at the previous candle's high and the next candle's low, you'll realize that they left a gap here. So price came, and the low of the next candle, we identify this level as a support level, so it's sensitive. So what price did is they came and they tested this level and went on the upside. So this on its own is a trade, and then they came at a later stage to fill up this gap too and found support on the low of this fair value gap and continued on the upside. So we can utilize this as a trade. And then if we jump to the next fair value gap, which is this one over here, you'll realize that price did come back to fill this gap. So price tends to come back to these gaps and just fill them up, or just find support on these gaps and continue on the upside. If we are on a bullish scenario, we have another gap here. They came to fill. Look at this. So imagine you were in a scenario where you are looking for this order block here to go long, but what price did is they just came to this fair value gap and they found support there and continued on the upside, which means your order was not filled. But if you have knowledge about how fair value gaps works, you'll be able to frame an entry here and continue on the upside, right? So that's how you will do it. And then we have our next fair value gap here. Price came and then found support on the low of this fair value gap. Usually the most probable fair value gaps are the ones that are coupled with an order block or a bullish order block next to them. So if price comes here and then you have confirmation that they're gonna come to fill this fair value gap, and then they might find support on this bullish order block, that's a high probability trade. You look for longs here and continue going on the upside. So let's do the environment or bearish scenarios, right? So we have this gap here. So what price did is they gapped down, but they came at a later stage to fill these gaps here. And then we have another one here. So with this one, they came to fill it up and then find support on this candle here. We'll call it the bearish order block. We just count these 3 candles and we turn them into one, and then when price comes to this level, they find resistance and continue on the downside. Then we have another one here. What price did is they came, then they found support, they found resistance on this fair value gap and continued on the downside, right? And they still came back at a later stage, but this time around they utilized this order block. Remember, we look at the one with the most range, and they found resistance here and they dropped, right? Even though they still continued on the upside. So another gap here we got here. So another gap here, price went down and then left this gap here. Price came back at a later stage, but they did not only fill the fair value gap. What they did is they filled the fair value gap and found support. They found resistance on this last up close candle, which is the bearish order block, and continued on the downside to take out this previous lows. And then we have a similar scenario here. They found resistance on the midpoint or 50% of the range of this gap, and then continued on the downside. We have this here. The price remembered that there is a gap here, and then they came to fill it up. So an insight: when we utilize fair value gaps, we either utilize fair value gaps for entries, one, we utilize fair value gaps for exits, two, we utilize fair value gaps for directional bias, three. When you talk of directional bias, is where exactly is price likely to go from here. So when we identify a gap, we'll be able to come up with a bias to say this is where price might go to, and then so that's how we utilize the fair value gap, right? Just go into your charts, try to identify this price events or patterns, and see how you can utilize them in your trading journey. So with these price action tools, the better you know all of them, the more a better chance of you framing a high probability trade setup. So like I said earlier, if you have a fair value gap and it's coupled with an order block, that's the most highly or a high trade scenario, or high probability trade example, right? So this is what we will be utilizing for the next 2 episodes of this series. So on our next lesson, we are going to look at higher time frame analysis. This is us looking at old highs, how we can utilize old highs and old lows, and how we can identify trending markets, and how we can identify consolidating markets. But when we talk about trending markets, remember that our focus on this series is only for boom and crash. So we are going to look at each of these instruments and just identify trending and consolidating market from them. With that, ladies and gentlemen, concludes our